Though you are seeing some signs of slowdown in the manufacturing sector and some of the manufacturing ISM indicators. Overall, I feel like for most Americans, it doesn't really feel like a recession because the labor market is so strong. And I actually think that there's a decent chance of an upside surprise tomorrow. So our forecast for non-farm payrolls is 300K. That's 50K better than the consensus. And even on top of that, I do think that there could be a trend where you do see services hiring, particularly in the summer months, better than expected, which is partly why you've seen upside payroll surprises in June and in May as well. So if that trend continues, then I do think that the dollar should strengthen and Fed expectations could be a little bit more hawkish than they are currently right now.
He's also calling for 4% at the next meeting. What is your call? Or, sorry, by the end of this year, 4% by the end of this year. What do you think?
Right. Well, that's probably a little bit higher than I think what we in the market are thinking, although we do agree with the 50 basis point rate move at the September meeting. So if you get to two more 25 basis point moves after that, that would basically bring you to around 3.5. That almost gets you to what Bullard is talking about. I think it's a little more difficult to forecast further out by the end of the year. Obviously, the Fed is on a very data-dependent approach, and some of the doves are really more talking about 25 basis point moves. So I do think that there is certainly a decent chance of the Fed funds rate getting to 4% by the end of the year. But I would say it's probably too early to say whether or not that will be the case.
Max, do you think the DXY is adequately pricing the scenario that we are seeing getting spoken about by the Fed? Because obviously you've got the Treasuries pricing the easing to come through next year. You've obviously got the Fed suggesting the entirely opposite, even if you think they maintain that stability at 3.5%. Or is the DXY just, I suppose, seeing a little bit of activity in terms of that strength on the back of what we're seeing coming out of the Eurozone and the weakness there?
I'd probably say that the DXY is really more reflecting this kind of recessionary risk that we've been talking about, or that the market's been talking about since mid-July. So I tend to agree with your view that we really shouldn't really be talking about pricing in Fed cuts in the first half of 2023. Even Fed doves like Minneapolis Fed President Neil Kashkari said he doesn't really see that as a decent probability at this juncture. So once the U.S. Treasury market and the Fed funds futures market kind of reprices that more in line with the Fed speakers, and as we think the market's going to do that as we see the incoming U.S. data, then we do think that the dollar has much more room to strengthen on the back of those higher U.S. yields and on the back of that repricing of Fed cut expectations in 2023.